All right, we should be good to go here. Technical difficulties on my end. But good morning, guys. Good morning, ladies. Good morning, gentlemen. We'll kick off the pre-market prep here for March 2nd. So happy hump day, guys. Shall not be a dull day. So we're going to hear from the Fed this afternoon. And let me just try to find something real quick on Twitter here. Let me see. Pull up Twitter. If I could find it. Just give me 1 second here, guys. Anyways, we're going to hear from the Fed today. And we did get a statement from Powell this morning that pretty much we should expect some rate hikes here in about 2 or 3 weeks. So I think the question going into hearing from the Fed today is not so much like I think if you have an expectation right now that they're going to back out and they're not going to raise interest rates at all in March, I don't think that's going to happen. So I think the bigger question is, is it a quarter point? Is it a half point? And what's kind of the schedule here moving forward? In terms of us in our trading, though, can kind of ignore all of that and just focus on the structure here today. So I got some key levels I want you to focus on. For your S&P futures and the SPY, 4,300 and 430. 430 for the S&Ps and 4,300 here for the S&P futures. Big psychological number, continues to hold up as support, kind of lines up here with your January lows. So focus on that level there for the S&Ps, and then for the Qsters here, you're flat into the open. You've kind of got that 14,000-ish. So a few levels to focus on. Just you're looking at January lows. So we don't got to get too specific about the exact level. My thinking is a big flush and, more importantly, a close under the January lows probably sends this market much lower. Because up to this point, early yesterday morning, the QQQ futures, I kind of come up here and give the 21 EMA a little smooch, and the S&P futures, a quick little kiss on the cheek before it turns back around and runs away. So we got the huge flush into Thursday. Everybody gets trapped short, and you get a pretty nasty, right? Really impressive, call it oversold bounce, right? Really impressive short squeeze. Structure hasn't changed. We're not even above the daily 21 EMA. So we got to keep the bigger picture in mind, because if we can't even start to improve the shorter term chart, and if we can't get back above the daily 21, get some positively stacked EMAs, get rid of the red 10x bars, if your shorter term time frame can't even clean up, we can't lose sight of the bigger picture time frames here. To me, the major focus is still on these bearish weekly squeezes. Bearish weekly squeeze for the S&Ps, a bearish weekly squeeze here for the Qs, and you got a bearish weekly squeeze here for the small caps. So I'm pretty much still under the same opinion. Any decent bounce to the upside, and up to this point, I don't really think we've gotten, we haven't gotten the move that I'm looking to short into. So from Thursday's low up into, the Monday, Tuesday highs, still not enough for what I'm looking for. But I'm still under the opinion any bounces here that aren't fixing these weekly charts, I'm looking to short that pop. We talked about this the other day on the Simpler YouTube channel. Just here's a major thing you have to keep in mind. What I love about the weekly chart is it just offers clarity, especially in hindsight. And you know what they say about hindsight. But it's really easy to look at that 2020, 2021 trend, and it's all pretty straightforward. You got a positive histogram, 21 EMAs pointing to the upside. You had positively stacked EMAs, you had green 10x bars, and every little pullback here just takes you to that weekly 21, and then the trend continues. So that's pretty straightforward. It's a pretty clean trend. The difficulty of trying to swing trade these trends is getting a little bit too caught up in the short term. Because we can look at this chart and say, yeah, there's your buy the dip opportunity. Like if you're really looking to play a trend and you really want to get the best, the lowest risk, highest reward entries, we would want to do that on these moves into the weekly 21. Or just the weekly moving averages is a general statement. But here's the difficulty. With that ultimate buy the dip opportunity on your weekly chart, your lower time frames get a little bit rough in the short term. So the weekly chart is perfect. The weekly 21 EMA is pointing to the upside. There's bullish momentum. Like everything's good. Everything's intact. But as we're pulling back to the weekly 21, look what happens to the daily chart. Things get pretty ugly in the short term. Squeezes start to fire short. The EMAs start to get stacked negatively, negative histograms. In the short term, it all gets a little bit bearish. Then throw into the mix, you hear in Twitter, you're hearing CNBC, right? Markets in turmoil. There's just a lot of emotion to that 2 to 3, maybe 4 weeks of selling pressure. And I'm not saying so much, hey, don't short that. There's money to be made trying to short that. But here's where you got to be super careful. The closer we start to get to that, those weekly moving averages, you got to be really careful loading the boat on, getting short and loading up on puts, because your weekly trend, despite the few weeks of selling pressure, it's still picture perfect. So take that list of criteria. The weekly 21 EMA was pointing to the upside. There's bullish momentum on your histogram and your 10x bars, right? Positively stacked EMAs, trading above the moving averages. Just take that list of criteria. We have the complete opposite right now. So now the 21 and the 8 EMA, they're pointing to the downside. Now we're under the moving averages. We have no stacked EMAs, and there's red 10x bars. And you got the first negative histogram in, let's just call this 2 years. So it's a complete opposite of that trend structure. So my thinking here is, hey, that kind of structure takes us higher. We can see that this kind of structure starts to take us lower. So the point I'm trying to make here is, you look at a pop like that one over there. That's what we're really trying to aggressively short into. Just understand, if the QQQ here over the next couple of weeks, if you get that bounce into 14.5, 15,000, just like that pullback, and everyone before it, they don't change the structure of your uptrend. If we bounce into that weekly 21, but we fail to break above it, doesn't change the structure of the downtrend, right? And if anything, that's your best shorting opportunity. But here's what would happen in the short term. Everything's going to clean up a little bit. All of a sudden, we're back above the daily 21. You probably got some positive histograms. The point I'm trying to make is you can play these, these week-to-week ebbs and flows. Just do so without losing sight of the bigger picture. Because what got really painful last year for a lot of traders was you're calling for a market top. We get the pretty good flush, right? So you might get a 2-3 week flush. But for the traders that are losing sight of this time frame, what can easily happen is you keep getting short, and then you're kind of, you're part of the very reason the market rallies like a bat out of hell. You're getting short in major support, and they pretty much just squeeze the crap out of you. So keep these things in mind here. Right? We might get that nice bounce up to 14.5, 15,000. Play that to the upside, but just understand, if we're not back above the weekly 21, then getting heavily long up here is no different than getting heavily short right here. So that's kind of the question you got to ask yourself. With that list of criteria and that quality of trend, would I want to get aggressively short as we start to approach the 21. And maybe that's part of your game plan. But if your answer is no, I want to be really careful getting, deep in short positions there. Well, the same logic should apply in this trend. A little bit careful about loading the boat on calls the higher we get. So there's your bigger picture. Just don't lose sight of that, because I think that's really important. In terms of the shorter term, you're not going to get that, what I think is a shortable rip into the weekly moving averages, if the daily charts can't even improve. So you got a lot going on in the world. You got a lot going on here for our market today with the Fed. But just in terms of daily structure, still no improvement. Negatively stacked EMAs. There's red 10x bars. So the question we got to ask at this point is that all she wrote as far as that bounce goes? Get the flush, back to the 21, hang out for a little bit, get the flush. Maybe this is just a reversion to the mean. Maybe it's all she wrote here. Where I think that becomes more likely is we start to go into the close, right? So on a closing basis, we start to trade back under the January lows. Because at that point, I think you get your flush, you got the oversold bounce, you got the next flush in the direction of trend, got your oversold bounce. If we can't break here and you're back under the low, I'd look for things to go make a new one. So if we're just trying to pick some basic levels for today's session into tomorrow, Friday, there's more levels to discuss as far as resistance up above, right? There's hourly 200s, there's weekly moving averages. Next 24 hours here, daily 21 EMA is a key level to the upside. Right? And don't lose sight of the bigger picture. Because you take that bigger picture on the weekly, it's the kind of structure that really can't afford to see the market hanging out under the daily 21. It's already kind of prone to want to just trend lower. So there's a key level to the upside. In terms of your support, you're looking in that neighborhood, your January lows. So now what can help us try to get a gauge of, are we going to break this to the upside or the downside, or are we going nowhere? That's where we want to start to look for some of those beautiful squeezes. So let's see, there's a 4-hour, 2-hour, 60-minute, 30-minute, 15-minute here on the QQQ. Right, so this is perfect. You can tune out all the bullshit today and just focus on this. There's your key level to the upside. There's your support to the downside. Now we've got 1, 2, 3, 4, 5, 6 lower time frame squeezes to work with. And so there's the 15-minute. It ain't the prettiest. Here's a 30-minute. We can work with that. Perfect. Here we go. This is perfect. Key level to the upside, right? Daily 21. Key level to the downside. Right? Those January lows. And now we got the buildup of energy. So pretty straightforward for us, throughout today's session. If we can't even fire the hourly squeeze, we're going nowhere. And into, hearing from the Fed, that might be the case. They might just chop this thing, kill premiums a little bit. But if this breaks to the upside, squeeze fires long, then it maybe triggers that 2-hour. Maybe that triggers that 4-hour. And you're getting a big breakout. Then I think we'll start to discuss, Thursday or Friday, where we really want to get ready to short to the upside. Mainly around those weekly moving averages. Or they all start to fire short. 15-minute fire short, 30-minute, 60-minute, 2-hour, 4-hour. Big buildup of energy. And if it all gets released to the downside and we're taking out the January low, I think we're going to come right on back down. So there's the 3 ways to look at the squeeze. If we can't even break an hourly, we're going nowhere. If it starts to fire long, it might trigger that domino effect. 15, 30, 62. Same thing to the downside. So you got some squeezes and you got some levels here. And you got a bigger picture context of where we're at based on weekly charts. Let's check the S&Ps. Get rid of some of these bad boys. All right. Yesterday's high, daily 21. You can call it 4,400 if that makes you feel good. And you got your January lows. And here we've got a weekly squeeze down to a 5-minute. All right, so very clearly, if we just take what we know about the squeeze, it's a buildup of energy. What's followed by a buildup of energy? A release of energy. It's taking place on your weekly down to a 5-minute. So old mama S&P's here gearing up to do something. Right, but there's our few levels. Let's take it to maybe a 60-minute squeeze here. And there you have it. If we can't do anything, we're going nowhere. If it fires long, then you look for the 2-hour, the 4-hour, etc. Same thing to the downside, right? We're a little bit closer to key support than we are from resistance. But say this is a squeeze you want to really, dial into today. This is going to be your focus. We'll kind of judge that hourly squeeze how we would judge any other time frame. Now, there's greater likelihood it's going to fire short. If you're under the 21, there's no stacked DMAs, and there's red 10x bars. If it's above the 21, the positive histogram, stacked DMAs, you're still looking for some of that same criteria just to get a better sense of, on an hourly chart, is this a bullish squeeze or is it bearish? But I kind of like going into the session here with a few key levels, whole bunch of squeezes, and now we'll see how it all unfolds. One more chart here for you guys is the VIX. And to me, above 33, 34, looking a little bit frisky here. Because I spend so much time looking at the squeeze in the histogram, just interesting observations. I don't think we bet the ranch based on it. But in terms of your weekly histogram, it hasn't been at these levels since the COVID flush. Again, that's just interesting. I wouldn't take that and run with it. In terms of my buy signals we're working on, first buy signal was that last Friday since October 2008. Interesting, if nothing else there. But there's a few things to focus on today, guys. I would be a bit careful. Expect a lot of chop, I would say, between now and the Fed. Expect that, and then expect if these lows get wiped out for things to start to get really hairy. Because the market just goes through cycles. And typically the cycles just continue to take it in the path of your bigger picture trend. So it's more so a cycle of, who can we screw here? So rope everybody into puts, just destroy them. And then on the other end of it, you're roping everybody back into calls. All right, back above the 21, everything feels safe. VIX is coming back down. All right, so you got to picture as they sell you those puts down here. Right, they're like, come on in, the water's warm. Right? They sell you those puts. Then they pull the rug out from underneath you. Right? They're buying the puts back from you now at a discount. Right? This is just how you want to think. So I sell you the put down here at $5 per contract. Right? Then I pull the rug out from underneath you, short squeeze you. So I sold you the put at $5. I'm probably going to buy it back from you up here at like $1. At the same time, right, you're covering your puts. Now I'm going to invite you into the upside. It's like, hey, I know I just did you dirty on that put that I sold you, but I got a much better deal for you. Or let me sell you one of these calls here for about $5. So they sell you that dream, then they screw you all over again. So just things to keep in mind here in the short term. A lot of emotions at the extremes. So that's why I think this low is very important, because you get the flush, you get the pop, but we're in one of those markets where we can go from bear trap to a bull trap. Right? And when do we go from bear trap, bull trap, bear trap, bull trap to just flat out bullish? That's when we start taking back those weekly 21 EMAs. So just expect a lot more of the same, guys. Expect a choppy session today. In terms of the individual stocks here, we've got some long positions in DWAC, which would love to take profits here today. We got some DWAC. Got a short position on Apple. Come on, Thinkorswim. Let's not start early here today. Come on. We've got a short position on Apple. Take my word for it. There we go. Expected issues, blah, blah, blah. Got the short on Apple. Got an IWM short and a short on Uber. And really no plans to jump into anything here early today. Got a few levels, got a bunch of squeezes. See how it all unfolds. So just be patient today, be safe, be smart, and understand, the move into the Fed, the move after the Fed. There are things that can change within a matter of minutes. So I think where you can try to get some clarity in the midst of a short-term, whatever you'd like to call this, where I think you can get some clarity is just really dial into a few key levels, and then generally understanding that anything between those key levels really isn't doing this market any good either which way. So something's got to give here. But that's what I got for you good people. If you got any questions, let me jump into the chat here and answer as many of those as I can. But we'll keep the VIX up for now. Won't be a dull day. That's my best guess. That's my best guess. Yep, sorry, I still short IWM. Fly Guy wants to take a look at EOG. Well, if you take a look at crude oil this morning, it was hitting like 112-ish. It's off a little bit. What's kind of crazy is the daily squeeze. Now the daily squeeze fires. So I think you got more left there. But yeah, I mean, energy oil names, this has been your momentum, your trend. And in terms of bullish structure, it's been your bullish structure. So names like Devon, names like EOG here, they're all looking really good. I think, especially in this context, because if you look at the weekly chart, and I think you got more upside. But in terms of risk management, we're potentially at this point in time. Meaning we already made what I think is the easiest move, which is the move off the weekly 21. So it's not to say we're going to pull back to the 21 here. Let's just take that into consideration. So I think all you want to do here is just proper choice of strategy and proper choice of risk management. So given that we're already a little bit stretched on the weekly chart, I'd probably try to lean into selling put credit spreads. Now, if you can get a dip and sell some puts around 108, maybe a little bit lower, even if this just continues to trade sideways, you're going to be in good shape. Because we can see the last 4 weeks or so, last 5 weeks, it is what it's done. It's generally traded sideways. And so if you got those put credit spreads, you're in good shape throughout all of it. So I'd go with put credit spreads on the next dip. But if I'm going to swing trade it, my exit is also going to be under the weekly AEMA. Now, I'd like to buy the dip to the weekly 21, but I wouldn't want to sit through it. So put credit spreads and an exit on a weekly close under your weekly AEMA. I like that. And I think if you could get a little bit of a dip here, the closer you are to your exit level when you get long, the better your risk reward. But it all still shapes up here. It all continues to shape up. And we're feeling it, that's for sure. Must be like $50 and change. You filled the car up the other day. We are feeling it. Hey, good morning, Andrew. Good morning, everyone. Good morning, good morning. Hey, Country Roads. Good to see you. Yeah, Robert. And the obvious statement is it's a little bit extended. I don't think it too much matters here. Crazy stuff, guys. Crazy stuff. Let's see, how's gold doing this morning? Gold was coming in a little bit. And I know a handful of you, or a lot of you, you're in the options room. So you heard Sam covering these in the Friday video. Outside of your indexes, if you're trying to get a sense of how is everything in the world kind of being digest right now? Is it causing fear? Is everyone not so much worried about it? Gold continuing to go up, oil continuing to go up, and a few other things kind of signals there's some concern here. Probably for good reason. All right, Cobra, you got some Oxy. Let me take a look at Oxy. Ooh, do I think it has room? That's always, is this an all-time high? No, it's not quite an all-time high. Does it still have room? It's always such a tough question for us as traders to even ask ourselves. Because for me, at least, here's a position that puts me in. So assuming you got a position here, and assuming based on the looks of the charts, this is going really well. From past experience, I'll catch a killer move like this, right? And I'll hang on for a little bit more. And I can't tell you like one time where I hung on for a little bit more, where if I actually got that little bit more, where it would have been a life changer. Right. So for me, I've never been in a position where, okay, if I can hang on and just get, can I get 48, 49, 50 out of this thing? Even the times where I hang on and I get that little bit of extra, it's kind of just like a drop in the bucket. I'm not retiring early, so to say. But what really stings is I took a good entry. In a matter of 2 days, I caught an above average move. And you let that all come back against you. So from that perspective, for me, that's where these counter channels are really helpful. So if we change this counter channel to have this measure 2 average true range moves from the daily 21, for me personally, this is typically the move I'm going to cash out into. If we can push through 2, get to about 3 AR, there's very few times outside of, certain circumstances where I'm going to look for any more. So it's not a question of, could this go higher? I think it's a question of, has it already made the easy move? And I kind of measure that easy move from the 21 into about 2 to 3 AR. So if we can take the position at the 21, say we buy 5 calls, here's where I think you're either taking all the profits off the table or maybe you're going to get rid of 4 of your calls. Pay yourself on 4 of them. Maybe you keep a runner there. But for swing trading, that's typically what I'm looking for. Give me the entry at the 21. Give me about 2 to 3 ATR. And hey, if I tap out and take profits at 33 and change, and it runs to 36, I can live with that. If I get a great profit at 34-ish, and I hold on for 36, and it all comes against me and goes back to break even, or even worse, a losing trade, it's frustration, but it's also lost opportunity cost, right? Because up there at 34-ish, that trade, right, if you just closed it, I could have moved the account forward, right? Every winning trade is a little nudge in the right direction. But if we hold on for a little bit too much, then it goes back to break even, or even worse, it goes against us, right? It's lost opportunity cost. We could have taken a step forward. Maybe best case scenario now is we're going nowhere or we're going backwards. So 2 to 3 ATR, that's where I'm typically going to cash out to avoid that kind of thing. And believe me, there's been plenty of markets. Last year's a great example. I'm gonna get long Tesla here. All right, let's take profits around 880, and then you sit back and you watch it go to 900, 950, 1,000, 11, 12. Ford kind of hit us with this. We're getting long Ford here. I want to say we're getting long around like 19 and change, 1950. We took profits right here. Continues to rip. My focus is, hey, what's the easier move that I can catch more often? And let me just try to catch it more often. So good question there. Now, with all of that being said, yeah, that chart looks like it's got some more left. With all that being said, there's things to keep in mind. Mr. Rocky, how are we looking here on Melly? Melly, good for a short. Let's jump to the weekly chart. Because remember the discussion we had earlier. 2020, 2021, you really want to be ready to buy the dip at the weekly 21 EMA. The problem is we're pulling back to that weekly 21 and that uptrend, we're sitting through 2 to 3 to 4 weeks of nothing but bearish chatter and noise in the news and the headlines. And probably those that we trade along with. But you still want to be ready to buy that dip. Right, so the daily chart cleans up a little bit here. But if we can anchor to the weekly, we get a much clearer picture. Weekly 21 EMAs pointing to the downside. No stacked DMAs. Red 10x bars. This structure hasn't changed. I think it's just a matter of, does it bounce enough to take us a little bit closer to that weekly 21? Because here's what we're looking for on the entry. There's your key level. Let's say the profit target here on a short is going to be right back, under those recent lows. So there's our levels, right? Profit target, sub 900, and we want to exit a trade on a weekly close back above that 21 EMA. So 12 and change. Now the only thing that we got to wait for, and maybe we're here right now, right? We just got to try to get a sense and then go play around in the Analyze tab. It says the current entry right now give us a favorable risk reward between our two targets. Right? Is an extreme example. If we're going to short it down here, Thinkorswim, you're already irritating me today. Ay, ay, ay. You know it's going to be a long one and the market's not even open yet. No, but if you're putting that short on, at 920, and your profit target is 860, but you can't use a stop up here at 1200 and change. Right? Very little reward and a whole lot of risk. Say you get your short entry on Melly around 1180. Here's what I love about that trade. You get a whole lot of reward to the downside, not too much risk to the upside. So you come in there, you sell that call credit spread, you buy those puts. That might be your risk, right? Bounces back above the weekly 21, heading into a Friday's close. It looks like we're going to close there. You cut it loose, right? That's a shift of structure. There's your risk. There's your reward. So that's how I look to play that one. But you can't use that weekly 21, right? You can't exit based on a meaningful shift of structure and still work a good risk reward if we're putting the short on down here. Right? Then we're probably going to get shaken out in the bounce into resistance. Right? So take that QQQ weekly chart. Very much like getting short here. then it goes against you. So I do like Melly for a short. All right, next up here is Snapchat. Anders, Snap has been interesting. All right, there's the weekly charts. Check the daily out. Yeah, I gotta like it for a short. Where I really like it is if we could just keep trading back under the 21. Right, no stacked DMAs. That's what I'd focus on. Daily 21, weekly 8 EMA. If you just want to pick a level here, you're kind of looking to short it under 40. Back above 40, you're starting to take back some daily moving averages. You're taking back the weekly 8. You probably got a bit more upside to go. But I think under 40 here, got your big flush, got the oversold bounce. It's trying to clear, it's trying to clear, it's trying to clear. Could roll right back over. So that's what I look for there in Snapchat. Evgenia, let me see. Let me just check what we're going to open up here. Truthfully, I would hold it to the extent we continue to trade above 4,300. If you want my honest advice. Because we might just get more of the same song and dance. Let's rip it, let's dump it, let's rip it, let's dump it. Let's exhaust everybody into the close, and all said and done, we've gone nowhere. So collectively, we got nothing. But above 43, I think you could hold on to that for now. Next up here is Dash for a short. Sorry, guys, this might be the last one here. We're going to open up in a few minutes. Yeah, I like Dash as well. And you got the right stack DMAs negatively, 10x bars. So y'all are calling out a bunch of good-looking charts for shorts. Understand what it all comes back to, though. So whether it's Snapchat, Uber, Amazon, like whatever the case may be, S&P 500 QQQs take out that January low, it all probably trades lower. Most of it. So that's the timing component. The market's chilling up here at the 21 EMA, and then you get that flush. Right? That's that moment in time, and maybe this is kind of it. But that's a moment in time where you're looking for your short entries. Right? That's where you want to short Comcast. Because as the S&P is hanging out near the 21, so is Comcast. And then when the S&P rolls over off the 21, so does Comcast. Right? And so does Uber. Same flush. So does Nike. Nike, Adobe, everything. So that's our biggest timing component right now. These all puke it up, most likely, if we break out, or if we break under the January low. They all most likely chop themselves silly if we just trade inside this range that we built here this morning. Under the daily 21, but above the January lows. Right? So what is Uber or Dash or any of these names likely to do in that scenario? The same thing. Pop, drop, not really giving you much direction. Just kind of giving you day-to-day headaches if you got a position. If we break above the 21 EMA here, and then we get the shortable bounce, they're all probably going to trade higher. So that's why I think into the Fed, into Thursday, Friday, make this your primary focus. You short Dash and this gives up the goods. Nothing's a guarantee, but you're very likely to be in great shape on your short. This fails to break either which way into Friday's close, your position's probably going to chop on you, and then vice versa to the upside. So that, my friends, is all we got here this morning. My apologies if I wasn't able to answer all the questions. I will be live tomorrow night, an hour after the market closes here on the channel. So 5 p.m. Eastern, 4 p.m. Central. We can pretty much hang out for as long as we'd like. Hour and change, hour and a half. So swing by tomorrow night if you can. Otherwise, focus on your levels, focus on your internals, and to some extent, try to work some patience here today while we wait for the dust to settle. Alrighty? But I appreciate your time, y'all. Have a good day, and I will talk to you very soon.